Hi everyone, welcome back to my channel Commerce Class. Today's video is about cash flow statement. Cash flow statement is a statement which describes inflow and outflow of cash and cash equivalents during specified period of time. Cash inflow means receipt of cash and cash outflow means disbursement of cash. So cash flow statement deals receipt and disbursement of cash, and this statement shows the causes of changes in cash position of an enterprise between two balance sheet date. Here cash means cash in hand and cash at bank. Cash equivalents are highly secured security or highly liquid securities. Usually marketable securities are cash equivalents. These are highly liquid securities. We can easily convert these securities into cash. So cash flow statement as a statement that shows inflow and outflow of cash. Inflow means receipt and outflow means disbursement. Classification of cash flows. Cash flow means inflow and outflow of cash and cash equivalents. So cash flow involves both inflow and outflow of cash and cash equivalents. The transaction which results in increase of cash and cash equivalents are known as inflow of cash, and the transaction which results in decrease of cash and cash equivalents are known as cash outflow. There are three types of cash flows in a cash flow statement. And first one is cash flow from operating activity, and second one is cash flow from investing activity, and third one is cash flow from financing activity. First one, cash flow from operating activity. So operating activities are revenue generating activities. Cash received from sale of goods and rendering services, cash receipt from fee, royalty, commission, etc. Then payment to suppliers and payment to employees are some of the example of operating activities. So these are usually income or revenue generating activities. And second one is cash flow from investing activities. Purchase and sale of asset and investment comes under this category. Interest received and dividend received is also included in this investing activity. Here dividend received means we are investing, or that a firm is investing its fund in long-term securities like equity and preference share capital and receives dividend from that security, and it is treated as investing activity. Then interest received. Interest is usually received from debenture and long-term loans. Suppose a company is the debenture holder of another company, and suppose there are two companies A and B, and A is the debenture holder of B. So here B issues debenture to A and A purchases the debenture, and B is issuing the debenture, so B has to pay some interest to A because A is the debenture holder. So in that case, A receives interest, and that is treated as investing activity. And third one is a cash flow from financing activity. Issue of shares, debentures, long-term loans, repayment of shares, debentures, long-term loans, etc. comes under financing activity. Now we will move to the statement of cash flow. So cash flow statement, we already explained that cash flow statement includes three activities. First one, cash flow from operating. Second one, cash flow from investing activity. And third one, cash flow from financing activity. And first step is calculation of first step is a cash flow from operating activity. Usually we want to find out operating profit, and we know that operating activity is the revenue generating activity, and here operating activity is operating profit. So net profit might be given in our question, and we want to exclude all non-operating profit or all non-operating expense and non-operating revenue from our net profit. So for that purpose, we want to add back all non-operating expense, and we want to deduct all non-operating income. Net profit, add all non-operating expense, then deduct non-operating income. Non-operating expense are depreciation, then transfer to general reserve, etc. Income like gain from sale of fixed asset, etc. And we want to add back all non-operating expense, and we want to deduct all non-operating income, and that after adding and deducting this non-operating items, we will get operating profit before working capital changes. Then we want to adjust the working capital changes, and we want to add increase in current liability and decrease in current asset. Then you want to deduct increase in current asset and decrease in current liability. Result after adjusting working capital as cash generated from operation. The next step is we want to deduct income tax paid, and the final result is cash flow from operating activity. Then a second step is cash flow from investing activity, and that involves purchase and sale of fixed asset and investment. It also involves interest received and dividend received. Interest received and dividend received both are inflow of cash. Then third activity is cash flow, or third step is cash flow from financing activity, which involves issue of shares, debentures, loans, etc. And these issue of shares, debentures and loans means inflow of cash. Here company is issuing these shares and company receives cash from public, so here cash is coming into the business, so that is cash inflow. And then repayment of loan, repayment of or redemption of debenture, shares, etc. are outflow of cash. So both issue and redemption included in this financing activity. The next step is calculation of net increase or decrease in cash flows. Here we got three flows, that is cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. We want to add all these three figures, and if the result is negative, and that is net decrease. If the result is positive, that is net increase. The next step is add opening balance of cash and cash equivalents, and the result is cash and cash equivalents at the end of the year, and that is the closing balance of cash and cash equivalents. That's about cash flow statement. Please subscribe my channel and share my videos. Thanks for watching my channel. Bye.